is simply noise. But the counter argument to that is, at the same time, we're rapidly going towards a cliff around climate, biodiversity collapse, water issues, and chemicals in our environment. On the environment side. And the social side, there's similar cliffs that we're going.
Good. Hi, everyone. Welcome to the Actionable ESG Talk series brought to you by AKFI Actionable Knowledge Foundational Institute, the world's first nonprofit industry consortium committed to bridging the gap between ESG, sustainability, and digital transformation. My name is Isabella. I am the co-host here with Manuel, another co-host, also the executive director of AKFI. And our special guest today, Gabriel. Welcome, Gabriel. Thank you for joining us.
Thank you, Isabella, and thank you, Manuel. And it's nice to meet all of you who are listening in.
Absolutely. Thank you for taking the time. And thanks to this talk series, we get to connect with brilliant minds worldwide to together discuss the current state and the future state of ESG, sustainability, and digital transformation. About Gabriel is the CEO at the Responsible Alpha, the company, and he founded, and he's also a CFA and a certified ecologist. Gabriel has led the deployment of more than $3 billion in sustainable finance while advising over 40 corporations in the S&P 500 ESG, sustainability, and climate. Thank you again, Gabriel, for taking this conversation with us. To start our conversation, what are your thoughts on the current state of sustainability, ESG, and digital transformation trends in sustainable finance?
I like the question. Thank you for asking that. I think we have to look and parse the question into parts, right? I think the first thing is, what is the trends? The trend is very different today than it was 10 years ago. For example, 10 years ago, I was at the annual conference for the CFAs Institute globally, and they asked, well, what do you do, Gabriel? I'm like, well, I'm working with communities around the world, protect forests, protect biodiversity, and take those actions and turn into financial products that trade on exchanges. And people are like, what? What are you talking about? But now, what I did then 10 years ago is standard practice. So if you look at the trend line is changing very quickly, although each day may be dire. On the other hand, while many of the ESG metrics or environmental social governance metrics we use each day have been around for over 100 years. It's like, Manuel, think of how many people are on the board, board of directors of a publicly traded corporation. That's an important ESG metric. Well, that's been disclosed for about 130 years. That trajectory is moving forward and continuing to improve disclosure and transparency, while there are moments in this trend where you might get noise. Right now in the US, for example, there's noise around anti-ESG. It's simply noise. But the counter argument to that is, at the same time, we're rapidly going towards a cliff around climate, biodiversity collapse, water issues, and chemicals in our environment. On the environment side. And the social side, there's similar cliffs that we're going towards rapidly as the have-lots continue to have more and the have-nots continue to have less, right? And the government, there's also similar cliffs on governance. And the issue with ESG is, it's like saying, I'm going over that cliff, as Bill Blow, a friend of mine, wrote this morning on LinkedIn, I'm driving 60 miles an hour. I decided to change my speed and only go 30 miles an hour over the cliff. That's applauded as ESG integration, when we need a completely different model to it, because we need to have our economy function within the planetary boundaries we all live and sit inside. So that's what we see. Some positive growth, a lot more discussion, but the crisis that we're facing around climate, biodiversity, water, and chemicals, and the crisis I mentioned on the S for social and on G are becoming much more immediate, and we need to turn this ship more quickly.
Thank you. Thank you, Gabriel. I think you're adding something to some. We say that there are two things in life that are sure: the taxes and the death. I think also falling off the ESG cliff and the planetary boundary, it's also as deterministic as the first two, because we really got to that point where first thing, the planet doesn't care about us. The planet is not here for human race to continue to thrive or grow or exist. So you really painted a very powerful picture of the trends and why ESG is here to stay, because the planet is here to stay. We don't have yet a spaceship to move 8 billion people around the solar system. But moving a little bit of this topic, I know you're very deeply involved and for a very long time in the financial industry. And sustainability and financial industry, ESG especially as a measurement of risk, it's coming very powerfully into the picture now. Can you give us some of the challenges the finance industry faces when it deals with ESG and sustainability?
There's one particular challenge I think is important to note. So first of all, we need to have a framework. So for us at Responsible Alpha, we have a framework that's borrowed from the Global Association of Risk Professionals that's been expanded to specifically address only ESG, sustainability, and climate risk. That's what we call ESG integration. This framework has 8 categories of risks, which we're not going to go through today. It's available on our website for free for everybody to review. The point is that the risks and the opportunities have different slopes. We look at a company, I know a couple of years ago, one of the large automakers in the United States was caught falsifying or lying or deceiving about their emissions associated with their diesel motors. That company lost 33 to 34% of its market cap in 24 hours. That slope is very steep. As that same company then has instituted risk procedures to mitigate that risk around deception, and at the same time change its offering, it has slowly increased in share price, but that slope is also very different. So we have unicorns on the downside that fall off the cliff, and we have unicorns on the upside that slowly walk up the hill. So you have to understand there's 2 very different momentums here. And that's a key, that's what makes managing a portfolio from an ESG perspective at times complicated from looking at risk-adjusted return. On the other hand, we have issues around transparency of data and consistency across sectors. That's gotten a lot better, and particularly in the last 6 years. Still, the issue we have here is there are procedures and then there's data. There's like what I intend to do and then what I did do. 2 completely different things. I can have a policy to transition to net zero. It's different than look at my path, how I have been transitioning to net zero, and can see the numbers change. So we have to change the dialogue from having a policy, that's good, to what are the actual actions somebody has taken in the past. And those 2 trends are what are most important right now.
Very interesting. And actually some or many times people forget that if a stock or goes down, like in your example is the Dieselgate, by 10%, to recover it has to go up by 11% or so, right? So the 2 slopes of the curves are never the same. But people think, okay, went down 10%, now it'll go up 10%. No. It'll be 99% of what it was, not 100%.
We also
So,
have systemic risks, right, that are at the sector level or at the supply chain level. And they're risks that we see and we know that are still not been priced in. You can think of two examples. It's a bit technical. I'll explain it in less technical language. Infrastructure. When we build infrastructure, such as oil, gas, pipelines, or other infrastructure, we have an account that we keep on the side that says when we remove, we have that, therefore we have the money to remove that infrastructure at a later date. Technically, that's called an asset retirement obligation.
okay.
And we have places in the world with tens of thousands of specific infrastructure, like the North Sea. How do we remove that infrastructure and restore those ecosystems to health? Because other sectors of the economy rely on that same ecosystem. Wild-caught fisheries, renewable energy rely on that same ecosystem and needs to be restored. We see systemically that that category of risk is not yet been addressed, and people have been writing about this for almost 20 years. So we can be right or correct, but not correct on the time. And another example is looking at how agriculture assets and agricultural products and biological assets are accounted for on balance sheets. There's a single standard that's used around the world, according to the International Accounting Standards Board. Why does this matter? If we want to address deforestation, biodiversity risk, community rights, regional economic stability in areas that are on the agricultural frontier or are producing agricultural products, we need to have a systemic approach, financial accounting and valuing of the production of those assets. We know that there are many loopholes there. So what that means in practice is literally an agriculture company can value its assets however it likes, because they're not liquid. They can choose a value. They can choose their own discounted cash flow model. They take that overvalued asset and they may go to you, Isabella, at a bank and say, here's my value of my asset. I want a short-term working capital loan. They go through credit review. You give me the money. Now I have a much higher amount of money than I would have otherwise because I've overvalued the asset. And in many cases, I can then buy a bulldozer or hire a bulldozer and clear cut the rainforest. We have caught companies doing this. And one company that I contacted their CFO, and they wrote off $80 million in the next 2 quarters because of that risk. But that's another risk that's not yet been factored into markets at the sector level. The first one on infrastructure, the second one on accurate pricing for agriculture production.
These are compelling examples, and I'm sure that we can you can give us 1 hour explaining the technical details on how this has been done or is being done. One sort of side question. Sustainability and ESG now puts the supply chain on equal footing with the company. In other words, when you report, for instance, on carbon footprint, especially on scope 3, different industries have between 60 and maybe 90% of their emissions attributable to the supply chain, to the suppliers. And we did study the data flow between the different suppliers and the companies that report on top of the supply chain. And clearly, in terms of how to align the data and the
Yeah, we see, so obviously at the S&P 500 level, the sum of the parts approach of 40 years ago would have said 80% of the value of the market capitalization of the S&P 500 40 years ago was real assets, and 20% was goodwill or related assets. Now that's flipped. Right? So now there are companies whose real assets are very small in comparison to the market capitalization versus their value of their goodwill. And so this type of thing matters from a systems perspective when you're looking at a company and you want to value that company. But what is happening with planetary boundaries is that's conflating that current model, that they're hitting each other. Because planetary boundaries says the valuation of a portfolio is the supply chain, upstream and downstream, and the physical assets and IP and manufacturing production of that facility. In other words, a broader definition of property, plant, and equipment. One can, if they like, look at a company and value it supply chain and property, plant, and equipment and come up with a different value versus what you might see how it's priced, how its shares are priced in an exchange. And that's where we see some, the disconnect. Because the value of the company should be based on how well it manages the supply chain upstream, how it works with its suppliers, how it treats its suppliers, and expectations it has around sustainability of those supply chains, deforestation risk, forced labor, slave labor. These are all very real, very real. And then they need to look at the value of the supply chain downstream, their buyers. For example, if I'm a corporation and I have a supply chain, I have a deforestation commitment or a plastics commitment, and I'm selling product to you, Isabella, and our commitments are different, there's a disconnect there, right? And that's where we see issues on supply chain and disconnects and risks being developed over time. So again, to summarize, you can look at a corporation from as some of its supply chain, that valuation, and its property, plant, and equipment.
And I think in a simplistic way, the economic models and the financial models should take in consideration the current and future price of the inputs in order to produce the goods and the services. And I think this is many times changed by political political system through subsidies, cross subsidies. Water for a long time, if not now, is still subsidized, or the price of water is not reflecting the real cost of producing and not the risk of running out of water. Definitely at the at the economic level of a country or a county, and so on. So if we can move a little bit more on the positive side, is there a case where maybe you can talk about the maybe responsible alpha, how it works, and help businesses to produce a better output by using sustainability, by using ESG? Many times we hear that businesses are concerned and resisting to include sustainability in their strategy because they consider it a cost. They put it on the cost part of the balance sheet. So I don't know if you have some thoughts and examples.
We have lots of examples. Our clients, many of them are repeat clients, noting that we're only a little over 12 months old, right? And we have over 50 people associated with the firm right now, the board of directors, advisors, and the independent contractors, of which I am also one, who work for the corporation. And we're a U.S. corporation based out of Delaware. So we have many repeat clients, and they come back to us because we simplify these complicated matrices around ESG into actionable items, either for the board of directors, for the C-suite, directors, or staff. It becomes what is complex and opaque becomes simple and easy for them to act upon and create synergies inside of their companies. And it helps they themselves determine their own path and how they're going to grow for the next 5 to 7 years, because they want to be here in 2030. The planetary boundaries we are at them right now, and there'll be winners and losers. And companies approach us because they're like, yeah, we're going to win, and you can tell us how to win, right? And so we work with different sectors and also different categories of staff within organizations. One of the examples is we worked with a very large corporation to design and distribute a very technical analysis on plastics that would then be used by over 180,000 of its staff. To give you an idea, so Manuel, if I say plastics to you, and I tell you how many plastics are there, you might think 7 or 6 off the resin identification code chart that we're used to seeing for recyclability. The issue is a large corporation that's in the packaged goods sector probably has over 10,000 chemicals it's using in the supply chain that they call plastic. So we have to create a lot of education and a systemic approach so people know what type of action they can take to mitigate the risks associated with the production. But at the same time, then come in and say, oh, we can replace that packaging with this other packaging that's much more sustainable. That was an example of a work that we did across a global category of work we did. Another piece of work we've done is we're helping a large foundation that's in 33 countries throughout Latin America create a internal strategy for its transition to a sustainable, low carbon, and equitable future based on its strengths, identify its weaknesses. This is being reported to the board. It's going to become its next 3-year to 5-year strategy. And it's going to help, and it's already helping this organization, even though we've only been doing this for a couple months, helping them win more business from the US government, the American Development Bank, and others, because they have the ability now to speak ESG in proposals and with their clients. Finally, it's helping this organization have a much stronger and better and defined impact in the communities that it serves in the 33 countries that's working in the Western Hemisphere. On the fixed income side, we are writing a book with a large financial institution right now on green bonds for sovereign bonds and for sub-sovereign bonds, like municipal bonds, and a way to expand the pipeline of projects that go into green bonds so more capital can go into green infrastructure throughout the world. That book will be out by the end of the year. So we have a lot of different types of projects. Oh, one more, sorry, we do a lot of different work. Another example is hedge funds and private equity funds have been hiring us quite a bit frequently for something very interesting. Many of the ESG reviews that internal staffing are doing, because they, like for us, we have 120 years of experience as direct ESG research managers. This is all for me, that's all I've done in my career. So I can look at a deal and say, oh no, this is what it needs to look like from an ESG perspective. Not the financial numbers, but the ESG perspective. And that's helping companies then take their M&A proposition. In one case, one hedge fund in Hong Kong raised $46 million off of our analysis. So companies like us, we create solutions for them. And we're very client focused, which is nice. Our contracting process is simple. A very large client called us on last Monday at 2 p.m. We had a contract by 5 p.m. And they were laughing, like, this is the simplest contract ever. I'm like, what do you want? Do you need it? How do you want it? How do you like to be communicated with? That's all I care about, right? It matters is that the client matters. We're client focused. Client always matters. And that's probably the most enjoyable part of this job, is working with our wonderful clients.
And people count also, because Isabella, for instance, it's working now to put together a group, a hub for conscious capitalists. So we probably don't have time to talk today, but we'll take a rain check to talk more about this aspect, because people change. People change a lot. The generations, the Gen Zers, Gen Alpha, are coming up with a totally and radical view about how we have to protect the environment. And the baby boomers and the other generations are starting to get the message. I think across. And as you said, right, they call about ESG. It's also about the future as much as it is about risks and finance.
Mm-hmm. Yeah.
So it definitely would like you back to talk about more compelling cases. We didn't touch on AI, by the way, and artificial intelligence and the use of technology, but that's another factor that we hope will recover some of the balance between human enterprises and nature and the
Yeah,
planet.
I do have a good case here on the AI. It's very short, if you like. So one of our clients is a hedge fund, and they've hired us to review whether the company they're investing in is lying to them, deceiving them. And so we applied deception science and not looking at the numbers, but looking at the words and how the words are distributed in documents, one can start to see lying over time. And this client was lying about their clients. I'm sorry, the company they're investing in was lying about their clients. We saw this in quarterly financial reports, one quarter after another, and the hedge fund changed its investment approach with that client. So what is deception science? So Isabella, if I asked you, what'd you do this morning? Like, well, I got up, I walked the dog. It was a normal morning. I had my normal breakfast. Or, Manuel, what'd you do this morning? 6:58, my alarm going off. I had to run. I forgot I forgot my suit coat. 7:15, I was in the car. I had to be in downtown Mexico City at 8 a.m. I was late. I got my cafecito from Juanito, who I always buy the cafe from. Okay. We have an idea. You probably can guess which one, not implying either of you were deceiving, because it's a hypothetical. You can probably tell which one was deceiving more than the other one. There are over 30 different metrics like this that we use with our client who provides us this research to assess whether companies are lying or deceiving in their SEC financial reports. That's important to investors.
And maybe there's the time to point out that Isabella is also an author. And about a year ago, a little bit more than a year ago, she published her first book, The Digital Mind of Tomorrow. And I can see a connection with your stories about using digital technology on both sides, right? To create nice stories, right? That flow nicely, but there are stories. And to use the same technology to detect also that they were created, by they are a figment of imagination, not reality.
Mm-hmm. Yeah, this is why like the dashboards on our website are really popular. So Isabella, for example, we did a dashboard that looked at toxic chemical releases and greenhouse gas emissions by congressional district. That doesn't make a value judgment on who is the congressperson in that congressional district, but it's a way of ranking the congressional districts by where is manufacturing occurring. We're in the process of putting together another dashboard that says which congressional districts are receiving more money out of the Inflation Reduction Act for sustainable investment, and ironically, the same set of congressional districts, which is very interesting. Where there's a need, where there's a demand is being met with the supply. It's coming together. And that's where you can see in data and storytelling, looking at financial data, we can put it into our map. Right? That's what our dashboards do.
Very, very interesting. Well,
Great. Wow. Very impressive stories, Gabriel. I think you have a list of them. You just ready to share whichever we're asking for, AI, how clients are lying to us, we can detect that. That's really interesting. I never heard a real story about that yet. And you're the first one brought it up on the ethical point of AI technology. So thank you for your sharing.
You're welcome.
I think, Isabella, this is material for your next book about using the digital mind of today, how technologies intersect um, with ESG, with sustainability. We definitely want Gabriel back, but I think we will like to move on for today. And maybe, Isabella, I turn to you. I think we have still a couple of more questions.
Thank you. What would your advice for people who want to pursue in the career, let's say in ESG and a sustainable finance, as a senior professional who has been doing this and still doing it?
I think the first and probably the most important thing is to participate. It is a haptic, a learning by doing sector. We can all fill out a report and provide, hole punch solutions. That's not what clients need. Clients are diverse as there are as many clients out there in the world. They need products and solutions that meet their needs in ways that they like to be communicated with. So people and institutions don't need a hole punch, sort of a standard product. They need products that make sense for them. And to be able to learn to do this as a professional, one needs to participate. Right. For example, talk to if you're at a corporation, talk to your investment committee that's managing your pension fund. How can I help the pension fund become more green? If you're managing profit at P&L, look at your own supply chain. What can I do to make my supply chain more green? If you're managing staff and you're making HR decisions, how can you make make the opportunities for that staff much more equitable? That's one thing that we have done. I launched the corporate, responsible office of corporation deliberately so I can bring my staff in as equity owners. And right now, I think the numbers, we have 6 as equity owners and another 9 that are projected to become equity owners. We're walking the talk on an equitable future. So you have to primarily, if you want to transition this sector, you have to do. Less thinking, now do. And there's any number of opportunities wherever you may exist in the corporation you're at, or the institution you're at, to transition, help those institutions transition, or to participate in a 4-hour-a-week sort of experience of job shadowing others. So we have many people that job shadow us, and they've used job shadowing us to transition into the sector. So far, in our first sort of 15 months or 12 months, we've had maybe 7 people do that, and that's really exciting.
Wonderful.
We have close to 20 interns at AKFI, and recently the biggest, I guess, maybe first or second largest university in Canada approached us to ask us to host more of their students as part of practical training, exactly what you said, the hands-on, the training by doing. And we are still a small organization and still in the formation stage. So we're very encouraged by what you said.
Congratulations, that's great news.
Thank you. Thank you, Gabriel. Thank you, Manuel. Thank you to all of our audience for tuning in today. Make sure to join us every week for a new episode of AKFI's Actionable ESG Talks series, where you can gain new perspective on how to mitigate risk and create value by integrating ESG and digital transformation. So until next week, goodbye for now. Bye, Manuel. Bye, Gabriel.
Bye-bye.
Thanks for today.
Thank you, everybody. Thank you.
Thank you. Bye-bye.